want to talk to the current homeowners and what's going on with you and what decisions you might be facing right now. So, firstly, renewals. Mortgages in Canada are usually 5 years or less. Many of you listening might be coming up to renew this year, next year, or the year after. Here's my advice. Number one, never take your lender's first offer. They never, ever give the best offer the first time around. 9 out of 10 people who get that renewal offer just sign it, send it back, and they're done. Don't do that. You will lose money. What you should do, you should talk with a broker well in advance of your renewal date. So if you're renewing in the next 6 months, then now is the time to be talking to your broker. What you need to be planning for now, not later, is understanding what kind of potential payment jump you're going to be facing. Also, if you're going to be trying to get access to more money or a different product, now is the time to work on your paperwork so that by the time you actually need to send the documents to the bank, you've got all your boxes ticked, your ducks in a row, for example. Recently, we had a client, had a couple of rental properties, and some of the tenants were paying them cash. And they just took the cash, and that was great. But lucky we engaged with the client early because we needed to tell the client to stop taking the cash and start putting it in their bank account so that by the time they came to renew their mortgage, we could show the bank statements showing that this client actually gets rents deposited. So just know that some banks require that rental income in the bank account in order to qualify for a mortgage. Maybe you haven't filed your taxes. Maybe you're self-employed. Do that in advance or talk to your broker about how much income you should draw. Maybe by taking an extra 10 grand salary this year, it's going to let you qualify for the mortgage that you need to get. So those conversations shouldn't happen in the month before you get your mortgage. They should be 6 months out so you can have proper time to plan. Some of you will have equity in your home. I always recommend at maturity to go and establish a home equity line of credit. You might be able to establish this line for 100 grand, 200 grand. You never have to use it. But the thing is, the fact that you have it, I call it your first insurance policy. If the proverbial hits the fan in some aspect of your life, you have some liquid cash to draw on to get you through some hard times. Many of our clients have survived these last years because of the fact that they established a home equity line of credit. Another thing to consider, if you have some savings over here and some investments over there, and they're earning a certain number, but you're taking on a mortgage, and especially you're jumping from a mortgage that's at 2.5% to 4.5%, now might be the time to consider selling some of those investments and paying down the mortgage. And that's where we would run some numbers with you and say, oh, if you sold that, you might pay some capital gains tax, but the impact on your mortgage and the saving on your term, it might greatly outweigh the impact of selling that asset. Again, now's the time, at time of refinance, to figure out, should you be reallocating some of your assets to kill your debt faster? The other things that are more personal, should you take a fixed or variable? I don't know. I'd need to talk to you to give you the advice on that. And what length? Are we taking a 3-year, 5-year? What's going to be best for you? And the one thing I would say to you is there are 4 Ps that we talk about with clients. They are, what is the product? What does it do for us? And the features for that product? Because you can get vanilla mortgages, you get more sophisticated stuff that will help you beyond just the interest rate. Next, prepayment. Does it allow me to pay this thing off faster? Some banks don't. Some lenders don't have very generous prepayments. Penalty. Many of you listening may have learned the hard way that if you take the wrong kind of mortgage and you exit it, you're paying tens of thousands of dollars when you exit, or you can't exit. There are some that do not allow you to refinance. You must sell the asset in order to get out of it. And finally, price. That's the actual interest rate. While it is one of the factors, it is not the only factor, and it should never be the only factor. You wouldn't think about that when you're buying a car. You need to look at all these other things and see the consequence of those things as it relates to price and vice versa. So that's what to do with renewals.